Hello there and welcome back. Chris here, bringing you back into another In-Depth with Chris discussion. Today's talk is going to bring us around the subject of trading biases. Biases are something that really exists in every aspect of our life, but in the trading world, being aware of them and knowing how to avoid them can directly lead to better trading results. So today we're going to talk about the 5 most common trading biases and what we can do about them. Let's get going. Trading biases can largely impair our ability to read the market objectively and make sound trading decisions. So we need to understand what they are, how they work, and all of that good stuff. So let's start off with the trading biases definition. So really what we're referring to is a cognitive bias that is a subconscious but systematic thought process that occurs when our brain takes a mental shortcut while processing information. This mental shortcut is caused by our tendency to prioritize and quickly process large amounts of information by filtering it through our personal experiences and preferences. Alternatively, a cognitive bias is a clouded judgment of a particular situation. As a result, cognitive biases impact how we make decisions and affect our actions. With that in mind, a trading bias is a cognitive bias that affects our decision-making process when it comes to trading. These biases can be caused by a variety of factors, such as emotions, past trading experiences, and even our own physiology. And ultimately, they can lead to irrational decisions that can negatively impact our trading performance. One of the most common biases known to man is the confirmation bias, and this holds true in the trading world. Confirmation bias is a cognitive bias that refers to the tendency to seek out, interpret, or favor information that confirms our pre-existing beliefs or opinions. At the same time, it makes us ignore or discount information that challenges those beliefs. In trading, confirmation bias can impact our decision-making process by leading us to selectively perceive and interpret information in a way that aligns with our existing beliefs without objectively evaluating all of valuable data. This can result in making trading decisions based on incomplete or one-sided information. Traders with strong opinions or biases about specific securities, markets, or trading strategies are most at risk of confirmation bias. An example would be if we're bullish on a particular stock. Confirmation bias will push us to only pay attention to information that supports our bullish views. That can include only reading positive earnings reports, favorable analyst ratings, and news articles highlighting the company's success. So how do we avoid confirmation bias? Well, simply put, we just need to be open and willing to see a complete picture. Some tips to avoid or overcome confirmation bias as a trader can include things like being objective in our own research, or challenging our own beliefs, or keeping a trading journal so it's more visible what our thought process actually looks like, or simply following a trading plan. Yet another good reason why a trading plan is a good idea as a trader. The next one that we'll talk about is the herd mentality bias. This is also known as herd behavior or herd instinct. Herd mentality bias refers to the tendency of traders to follow the actions or decisions of the majority of the quote-unquote herd without independently evaluating an investment's underlying fundamentals or risks. This bias is primarily driven by the belief that since everyone else is doing it, it must therefore be the right decision. Unfortunately, this is not always true. Now, we can avoid this by conducting independent research. We want to be thorough with our research and avoid making trading decisions solely based on rumors or market sentiments of an individual or the actions of said individual. We also want to practice contrarian thinking. This is a great way to challenge the herd mentality because it encourages us to take a different stance from the majority. And we can also trust in our own analysis a bit more. If we have confidence in our own reading of the market situation, even when it disagrees with the herd mentality, we might be less inclined to throw it away and follow the herd. Next up, we have the overconfidence bias, also known as overestimation bias. The overconfidence bias refers to the tendency to overestimate our abilities, our knowledge, or the accuracy of our predictions. This leads to an inflated sense of confidence in our trading decisions, which can result in taking excessive and unnecessary risks. Usually, traders who have experienced recent trading success are most at risk of overconfidence bias. They start to develop a feeling of "I can't go wrong" whenever they make a trading decision. Fueled by their false sense of superior ability to predict market movements, they start taking larger positions and higher risks than logically makes sense. So how do we avoid it? Well, at its core, the key to overcoming overconfidence bias in trading is to understand that the market is largely unpredictable. Therefore, we can't be right all the time. This is important to remember. We can also seek feedback and advice from peers or mentors or other traders in general. We also need to set realistic expectation. This forces us to acknowledge that trading does involve risks and uncertainties and to account for them. Then we can also practice self-awareness. Being mindful of how our thoughts and emotions influence our approach to trading can help us recognize when we might be feeling a bit overconfident. Then we can also use objective criteria or do our best to do so. This can include technical analysis or fundamental analysis and other data-backed tools to inform our trading decisions more so than relying solely on our own intuition and gut feelings. Number 4 is recency bias. Recency bias or availability bias refers to the tendency to rely too heavily on recent or readily available information when making trading decisions. At the same time, neglecting older or less easily accessible information is also part of this process. This trading bias can make us overly influenced by recent market events or trends, which may not always indicate long-term market patterns or trends. It can also contribute to herd mentality market behavior. If you're the kind of trader who tends to focus solely on short-term market movements and news rather than taking a more holistic and long-term view, you may be more at risk of something called recency bias. So how do we avoid it? Well, we want to follow a systematic approach. This involves making trading decisions based on a well-defined set of criteria rather than making impulsive decisions based on recent trends or events. We also want to practice critical thinking. This forces us to question the validity and reliability of the information we're receiving before we're actually making a trading decision. And we can also take a long-term view. Trading is a marathon, not a sprint. We want to avoid jumping to conclusions based solely on recent information and seek multiple perspectives as well as sources of information. And finally, we have number 5, loss aversion bias. Loss aversion is the tendency to strongly prefer avoiding losses over acquiring gains. Think about that for a moment. Sometimes we find ourselves in a scenario where we're more afraid to lose than we are deserving and desiring to win. This can negatively impact us, and the ways we can avoid this concept is by setting clear stop loss and take profit levels and sticking to them. We don't want to let our emotions influence our decisions while we're involved in a trade. We also want to practice disciplined risk management. This can help us objectively manage our trades and avoid becoming overly attached to a losing position. Next, we can focus on probabilities, not absolutes. Trading is a game of possibilities, so losses are unavoidable. By focusing on our trade's probabilities and statistical outcomes, we can better detach our emotions from individual trades or particular investments. Overcoming trading biases is a crucial step in becoming a successful trader. It allows us to take a huge leap forward in our profitability because we're taking a whole lot of unnecessary baggage that we're carrying along with us and we're shedding it off. And some of the processes that we go through in order to overcome all of these biases can be summed up as simple as actually adhering to a logical trading plan. Chances are you're already in the process of fighting off biases and you might not even know it. But until next time, happy trading and good luck fighting off those biases.